Yo, what's going on? It's your boy, Chak Investing, back with another episode here on my YouTube channel. I'm going to be talking about a very interesting topic today, specifically one of the most, we're going to be talking about something that I think that a lot of people really struggle with. A lot of people really struggle with this part. Um, and that is setting your stop loss. Okay. For the 2022 model. So on this channel, you guys know that I trade the 2022 model, but even if you don't trade the 2022 model, I think that this is going to be very important for you either way, especially if you're an ICT trader. Where do I set my stop loss as a trader? When you're taking executions, we're going to be going over that today. But before I get into that, if you'd like to support me, even if you don't want to support me, but you just know in your heart you're kind of a good person, or even if you don't think that you're a good person, but something's kind of egging you, like, hey, let me just like do something that I don't necessarily have to do for somebody else. Just be a little bit generous today and click that like button. Not asking for any donations, no handouts, not asking you to pay me in any way, form, or fashion. It's all free of charge, and I just like to do it in my free time. So, I'd like it if you could just help me out. Press that like button, and subscribe, click that notification bell, and that way you can get more and more information as soon as it comes out in terms of how to best trade the 2022 model and use that to pass your accounts. By the way, here's the latest update on my funded challenge. It's a 50K account. I'm up 1,300. I was up about 2 grand at the end of last week, and then market volatility has been pretty choppy. Wasn't able to catch many good moves. Had a little bit of drawdown, but that's why learning how to set your stop loss and learning when to pull out of a trade is very, very important. That's actually going to be a very different video. I'm going to go over how to pull out. And for you dirty minds out there, don't think about it that way. All right. But I'm gonna say how to pull out of a trade. But today, right now, we're gonna go over how to set your stop loss. Okay. So let's go over what the typical stop loss is for the 2022 model, right? So, don't mind this. This is a profitable trade that I took today on the 2022 model, a PM trade. But how do I know where to set my stop loss for a 2022 model? Well, let's go over what a 2022 model is again. All right, just for you that don't know. And keep in mind, this is not just for the 2022 model, right? This is for multiple other, types of trading entries, especially that are ICT. But let's go over how to set your stop loss specifically for the 2022 model. So for the 2022 model, what is it again? All right. So you make a high, then you take out a low, this low right here, a recent low, right? So let's say for example, you were trending downwards, right? Lower low, lower high, lower low, lower high, lower low. And then let's erase this. Lower high, lower low, break of market structure right here, right? This high was broken, right? So market structure was lower lows, okay? Lower highs. That's what we call market structure, by the way, where price is making a series of lower lows and lower highs. That is a bearish market structure. And then vice versa, when you're making higher highs and higher lows, that is bullish market structure. A lot of times you want to be trading within the immediate market structure that you're seeing, depending on the time frame you're trading at, because that's where the highest probability is most likely to be. A lot of times you hear trend is your friend. Obviously, that only applies in select case scenarios. But let's just think about it this way, right? So price is moving bearish. How do I know that price is likely to move in the opposite direction? Well, that's because I'm seeing a break in market structure that's indicating that we are bullish enough that we were able to make it over this past high when we have not been able to do that prior to, right? So that there's enough price action that is justifying a higher move, okay? So we break this market structure, but what's another thing that we also had happen before we broke this market structure, right? Pause the video if you can't remember. I've already said it already, but just think about it, right? We took out this low right here. So we've taken out liquidity, all right? Now we have enough reason to really reasonably believe that we are going to actually go, in the opposite direction. And that is even stronger when there's like an old low over here, right? Let's say price was moving over here, and then we also took out liquidity on this side, right? So we took out two pockets of liquidity here. That's even stronger. Then we break market structure, all right? And then there is a fair value gap, right? There is a gap, right? There's a gap that we retrace to, and then we break away, all right? So this is the 22 model, right? Very easy to spot, very easy parameters, right? But a lot of people kind of get lost in one area. Where do I set my stop loss? Now, ICT teaches that your stop loss is supposed to go here at the lows, right? That's where ICT teaches that your stop loss is going to be. However, now this is a lot of things that people won't teach you, right? So listen carefully. There are areas where you can actually optimize, right? Where you can actually optimize your 22 model entry so that you can lower your stop loss, right? So that you don't have to wait as much for a movement to get the same risk to reward on the upside. What do I mean by that? Think about it this way, right? So take your long position right here, right? If my stop loss is this wide, right? If I want to get a 1 to 3, I have to move, how many points is that, right? How many points is that? It's almost 400 points, right? 400 points. Sorry, excuse me, about 100 points. I was looking at this, my fault. It's about 100 points. Look at that, right? From 20,210.75 to 20,308. That is about 100 points in movement. You don't get that every session, right? Usually only on days where, we're trending in a certain direction. On days where we're just moving back up and down, you may only get 50-point movement. You may only get 25 handles in a session, right? So one of the key things that you want to be able to do, especially as a shorter time frame trader, especially on your 1 minute or your 5 minute, right? You want to really refine that stop loss so that it's much lower, so that in order to achieve the same 1 to 3, price has to move in a much less, price doesn't have to move as much, right? So here, comparatively, to make the same amount of money, price only has to move half the amount, about 50, right? So how do I refine my stop loss, right? As a beginner trader, right, when you're just taking your first executions on the 22 model, quite frankly, you should not be worried about this, right? When you're starting to trade the 22 model, you should be keeping your stop loss at the lows always until you feel comfortable in the things that I'm about to teach you, right? So, and before you execute on the things I'm about to teach you, what I would advise is that you go in the market and back test this and go and check for yourself so that you can trust that it repeats itself in real time. So that when price is coming against you and it's looking like it's going to hit your stop loss, you're not really that worried about it. Okay. So where are opportunities for you to be able to refine your stop loss, right? So let's think about that. All right. So think about it. What is the point of a stop loss? The point of a stop loss is to say, hey, if price moves this far, it's very likely that it's going to continue going in the other direction and I should get out of this trade. It's basically a protector for you. It's your guardian when you're entering a trade. I don't believe people who say, oh, yeah, we shouldn't have a stop loss. That's some nonsense. You need to have a stop loss, okay? Right? Because price can just swing against you. You don't know when the market, when the handyman is coming to manipulate price against you, right? So you need to have a stop loss, right? But where do you set it? So like I said, let's take this for example, right? Low, right? Low. That gets taken out. Then high, break of market structure. You can see here that we had a series of lower lows and lower highs, right? Lower lows, lower highs, until we took out this liquidity here, right? And you can actually look to the left. It's even stronger when you're reacting from a PD array as well. You can see, zoom in on that. We're reacting from this 1 minute fair value gap all the way to the left, right? Don't worry over time if you didn't spot that. You'll be able to get your eyes sharper over time. Look at these things in the market. You will notice We're reacting from this fair value gap all the way over here to the left. And this is one of the premium, this is one of the PD arrays that ICT talks about. Go on his channel, talk about, go and search up the PD arrays. He has a bunch of different videos on it. This is one of them. Basically, these are levels where you anticipate price to interact with or have some sort of level of interaction with. It may either bounce off of it, you may either go through it and come back and touch it and then go lower, right? But in this scenario, I'm looking for higher prices, right? Why I'm looking for higher prices is because that's where my bias is. We can go over that. That's not the point of this video. I really want to stay on topic and go over stop losses. Don't worry, later I will have tons of videos on different 22 models and examples and why I took this one, why I wouldn't take that one. We'll go over that later, but let's just focus on where I would set my stop loss. So my stop loss, if I'm just a regular 22 model trader, if I'm a beginner, it's going to go below this low, right? Once I've seen it break market structure, it's going to go below this low, right? Once I enter, it's going to go below this low. But there are a couple things that can prevent price from coming lower, right? What's the first one? Inverse fair value gaps. Okay. So what is an inverse fair value gap? One person who really talks about this a lot that I really like, Dodgy FX, go and check him out on YouTube. He talks about these inverse fair value gaps a lot. He'll be able to explain what those are to you. But essentially, what an inverse fair value gap is, it's the opposite of a regular fair value gap. So remember in my older videos, we went over what a fair value gap is. So let's look at this one right here, right? It is a gap in between two candlesticks, or in between three candlesticks, sorry. So, right, so first candle A, candle B, and then candle C. We see that in the wicks, right, price is wicked, but it left this body open, right? It left this body open. This body of the candle has not been overlapped by a wick on the candle to the right or to the left of it, right? So that is what we call a fair value gap. This is very sensitive, right? A lot of times price will come back to it. If it doesn't refer to it immediately, if this next wick up here on the fourth candle doesn't come back and touch it immediately, it'll come back and reference it later and it can use it to react off of, right? And so that is a regular fair value gap. But what is an inverse fair value gap? So you'll notice, look at this fair value gap right here, right? In the same 22 model. This fair value gap, right, is what we call a SIBI. That's what ICT calls it. Sell side imbalance, buy side inefficiency, right? Essentially, it's the same pattern, but on the downside, right? So normally you expect price to come there, react off of it, and then go lower, right? But it has now inverted the level, right? So what does that mean? It has now inverted the level. Let's put this back here. This one right here. Put back. Which means that it did not respect it as a premium array to continue to go lower. Instead, it actually went through it, right? And used it as resistance. And used it as support to go higher, right? So a lot of times you'll see price, when it has an inverse fair value gap like that, price will go and close outside of it. You don't want to see it come back through and close through it, right? You can actually use this as an area that if it returns back to it, right, it can be used as support. Price should not even be wicking through it mostly. Sometimes it can, which is why, we'll go a little bit further into this video, right? You can't just use inverse fair value gaps as your stop loss only. It has to be used in context, right? But it's one of the things that can be used, right, as a way to kind of refine your stop loss, right? What's another thing that we can use? Breakers, right? So what's a breaker, right? A breaker, right, is either a series of candles or it is the highest candlestick in a series of candles, right, where price can interact with and then no longer need to actually continue to go through it, right? Once it closes above that series of candles, right? So essentially, let me explain that a little bit closer, a little bit better. I don't think I articulated that the best. A breaker, right, is where price makes a low here, has a high, and then a lower low here, right? And then breaks through, break of market structure, right? It breaks through, and then these candles right here, right? Technically, price should not be trading all the way back through these series of candles that are on the left side of that breaker, right? And the same thing happens on the inverse side, right? If you want to learn more about breakers and how they actually work, and the more technical science of that, ICT Talk has a lot of really good videos on it. I'm sure he can opine on it a little bit more, but that is basically the pattern of a breaker. It kind of looks like a 22 model, right? Except sometimes the breaker doesn't always have a fair value gap in there, right? So this right here is the sensitive part of the breaker. So you'll notice, right? Drop from here, and drop to here. This area, price, really, when it comes back down, it should not go back into this area. In this particular scenario, we actually didn't even see price come back into this breaker, which is actually a really, really good bullish, scenario, right? But I'll try and find another breaker here where you can see what I'm talking about. Maybe you'll see like price actually interacting with the breaker. Let me find a really good one. It's around 9:30. A lot of chop around 9:30. It's not a good one. Let's go to yesterday's move. This Monday, a lot of choppiness on Monday. Okay, here's the inverse, right? So we had a high, then we have a low. Here's the higher high, right? Higher high right here. So this series right here, these candles is what we would call a breaker. Let's call this a breaker right here. And you can see, right, you could have set your stop loss up here on this 22 model, right? This is a 22 model, right? High, low, high, breaker market structure, fair value gaps. Price retrades into them, sells off, right? Very simple 22 model. Now, this breaker right here, you see price is only hovering in the bottom half of that. That shows that it is very bearish, right? Price is likely to be in your favor. If you're seeing price only hovering in the bottom half, right, you know that price is likely to go downwards. Also, another thing to keep in mind, we didn't go above this breaker. We didn't go above there. And guess what we also have? An inverse fair value gap. Look at that right there. An inverse fair value gap. You see that? It's a fair value gap that price did not bounce off it. Instead, it went through it, right? And you can see that price does not go back above it. So now you have two PD arrays that you looked at that when you see that there, you don't need to necessarily keep your stop loss all the way above here. Price didn't go above this breaker. It didn't go above this fair value gap, inverse fair value gap. When you see something like this nested in a bigger PD array that you're also interested in, I'd probably keep mine just to be safe. Stop loss right above here, maybe 2 to 3 points, 4 points, right? Because sometimes price can kind of just wick and interact it with a couple points or so. So you want to keep it like maybe at least 2 to 3, 4 points above. But you don't have to wait all the way up here, right? My RR on this trade, let's say I just even enter at the lowest, lowest fair value gap right there. I can put my stop loss right here, a couple points above, like that. 1 to 3. If I waited all the way up here, right, that's only a 1.96 trade, right? Only 1 to 1.96. I would have to wait for such a larger move to get that same 1 to 3, which we did end up getting, but you're not always going to get that, right? You don't always get that. So what's the rule of thumb here? We've now learned 2 PD arrays that can lead to better stop loss management. Right? There's another type as well that I want to go over. But before I go there, another thing that's important to know is that really what you want to see is 3 PD arrays in the way that could prevent price from hitting that low, right? Right. So there's 3 PD arrays here that we can reference, right? You have this breaker, you have this inverse fair value gap. But what do you also have? You also have these inefficiencies right here, these fair value gaps, right? These 2 right here. That's 3 different PD arrays. If price is able to wick through and go through all 3 of these, it's very likely that price is not in your favor, right? So, that's kind of the idea behind the stop loss, right? You don't need to wait for it to go all the way to the bottom right here, right? If price is already breaking through here, it's very likely it's going to go to the bottom anyway. You should check that out in your backtesting. Don't just take my word for it, right? But this is going to help you when you're setting your stop loss. If you can find and identify 3 different PD arrays that are in the way, right? A lot of times you can also use a wick. That is the other thing I was going to talk about, but I don't have an example on hand right here. Maybe I can share one in the community tab. But if there's a strong wick somewhere in this price action over here, you know, even over here, for example, right? This wick right here. That is look at how price is interacting. Look at how price is interacting with that wick. You can see that it is also a PD array. Look, we just closed just above the CE on it. Use the CE as support, go higher. That's this wick right here. You can tell that that's also a strong PD array as well, right? Look at price, you know, basically using the bottom of it as support, right? Then we come back up, we touch the CE, and then you use the CE as support right here, and then we fly higher, right? So that's even 4 PD arrays that we have here, where it's like if it goes anywhere below this, it's very likely that price has enough momentum to keep going lower, right? So you don't necessarily need to wait for price to hit all the way towards the bottom to set your stop loss. So anyway, you know, happy to do more videos on this. If you guys have any examples that you want me to go over, you know, feel free to join my Discord, and you can send in examples in the chat and say, hey, Chike, you know, hey, Check Investing, where did I, where should I set my stop loss on this trade? I'll be happy to walk you through and go to that exact candlestick and send it in the chat. You know, send you a markup of where I think that stop loss could have been put, or where if it had hit that certain level, then that's where earlier could have gotten out earlier. But you know, this is basically one of the major best approaches when you want to set your stop loss that I would recommend going over. And going back and back testing this is very important. All right. But anyway, don't want to yap anymore. Hopefully this has been an educational session, and I'll be going over future, you know, examples. So please let me know in the chat what else you guys want to learn. Don't forget to press that like button and subscribe if you want to learn more. And until next time, stay safe, stay loved.